Hi there. Tell me why Upstart had this bump in the stock price in 2021 over 600% and then a decline over 96%. So all your gains went down, but then the stock price rebounded from $13 to $47, almost 4x. So tell me why that happened. And as you can see right now, the market cap is about $4.4 billion. So this company is still small. Now, let's answer this question. Why the stock price went up and then down and then up again a little? And the stock price might go back to $300. Of course, that won't be possible because I will tell you later why. But another double or even more than that, $200 may happen. They have their chances. So if you understand why this bump has happened, then you can predict the future outlook of this business and you can have another bump in the stock price. So let's begin. If you look at their presentation, if you wonder what this company does, you can simply read this. They connect consumers, customers to banks and credit unions to leverage their platform, Upstart artificial intelligence platform, their models, and to deliver better credit products. As the banks and credit unions use their app, their platform, AI platform, they have lower costs of originating loans. And that results in better rates for consumers. So it seems that for the moment, there is a need for this platform. And that's great because they can increase their loans, attract more banks to their ecosystems, and more customers to use their platform, Upstart AI. Now, to understand why that decline happened in the stock price, you have to look at their revenue. In 2022, you can see here, over the last 3 years, the revenue was around $900 million in 2020. Then in 2023, a decline to $560 million, and then the revenue has started to rebound, to increase back to $645 million. And this is why you had these ups and downs in the stock price. And if you look at their past numbers, let's say over the last 5 years, you can see that in 2021, the revenue was even higher, and they succeeded to make a profit. So you see 2020, a small profit, a jump in the revenue, and also in their net income. Then the revenue has started to decline, and so the stock price. Back 2023, and the stock price was about $14, and then, as you can see, a rebound and also decrease in their analysis from 2023 to 2024. And that's why the stock price has started to rebound and deliver a nice return over or close to 300%. And as this company is expected to grow more in the future, the stock price may continue to go up, to increase even more from this level, to go back to $100 or $200. That may happen. They have their chances. Because if you look at their outlook, let me show you here, the total addressable market, based on their expectations, is around $3 trillion. They offer loans to personal consumers, other loans, mortgage, home, and small businesses. And as you can see, those markets, subsegments are quite high. And you compare their total loans on their balance sheet, let me show you here, 700 million, right? 700 million. And compare those loans to this total addressable market. So they have a lot of room to grow and increase their revenue. Now, another thing you have to look to see whether the stock price will go up in the future is to look at the revenue. So, for the full year 2025, they expect the revenue to be around $1 billion. Compared to 2024, let me show you here, the revenue was around $676 million. and 1 billion they expect for 2025. So you see a huge increase in the revenue, which is higher than 2021. And back then, the stock price was even higher. Be aware of that. And then you look at their net income, final earnings, at least break even. So they expect to also increase their earnings, to reduce their losses, and they might report a small profit. If they can do that, the stock price is likely to go up. Now, what you have to be aware over the next 5 years is to see another increase in the revenue and come back to their earnings, to report a profit, and that profit to increase more in the future. If they can do that, for sure the stock price can rebound. And you have to be aware of two important things. The risk they take, the loans on their balance sheet, because if they have a high number here, the risk is higher. So that's why their goal is to, here, if you read here from their presentation, their intention, their goal is to reduce the amount of loans held on their balance sheet. Because if they have a lot of value in their loans on their balance sheet, if these default rates increase, they will have high losses. And that's the risk for them. That's why they're trying to get rid of loans, to sell to other investors. And their aim is not to increase their loans on their balance sheet. Because if you look at the revenue, you see here, revenue from fees. Most of the revenue is from fees. So their aim is to connect consumers, which are over 3 million, to banks and credit unions, to use their platform and offer lower costs for borrowings. That's their aim. And the more loans they originate, personal loans, auto, home, and for businesses, the more they get in fees. And if they can improve those underwritings, their models, to create better and better loans for their customers, then Upstart will do well in the future. Quite well. Also, they accumulate more data, they can improve their models, and overall, in the long term, they can deliver better results than the traditional banks and other credit unions. So their story seems quite nice. Also, if you look at their transaction dollars, you can see that the majority of their loans are from personal loans. And they started to offer auto, you can see here transaction dollars, 43 million, the amount, and home equity loans, here, LOC. And as I said, if you look at personal, auto, and home, you have 150, 670 billion, and then 1.4 trillion. So they have a lot of room to grow. Now, another good thing about this company is the management. The management owns 18% of the common stocks outstanding. So the public shares that normal investors like us can invest. So the management owns 18%. And it's quite a lot. Especially the CEO owns 14%. And this is quite important because if you look at the number of shares over the years for Upstart Holdings, yes, you see an increase in 2021 when the stock price was quite high and they took advantage, and that's great. Sometimes it's great to issue shares when the stock price is way overvalued because you take the money and invest in your business. But then they stopped issuing more shares, as you can see. Quite the opposite, it went down in 2022. Maybe they did some buybacks, I'm not sure of that, but you can check. And this is quite good because you have a stability in the number of shares. Also, the management has incentives to keep the number of shares at the same level, not to increase it. Of course, if you look at their guidance, they expect the number of shares to be around, here, basic, 95 million shares. So you might see a small increase. Now, you don't have to see another increase like this, especially when the stock price is quite low. Because if you see that, that's value destruction. You don't want that. But as the management owns quite a good percentage in the common shares, you are aligned with their goals. And this is also important. You can also look at their compensation, especially the CEO over the years. You can see that the compensation has decreased as the stock price has declined, because also their stock options got lower because of lower stock prices. But what's the most important thing about this company to assess if they can grow more in the future? I mean, to have a market cap, an increase in the market cap 2x or 3x, is to see an increase in the revenue, and that happened compared to 2023 from 50 million to 60, and then to lower their expenses. They did that also. This is a good sign, from 250 million to 172 million. And for 2025, the revenue to be 1 billion. And then their losses to break even, they might report a profit. And if you see that over the next 5 years, the stock price for sure will rebound. And then you have to be aware of the default rates, especially to get rid of their loans from their balance sheet. I mean, to have a small amount so that they can manage the risk better. And if you see that, for sure this company will grow in the future. Now, this is the upside. The story of this company looks quite nice. The only problem I see with this company is the competition. You have to ask yourself, how hard is it to build an AI platform like Upstart? And if the answer is easy, also other companies can do it, then that will be a problem. Because if you have more competitors, more AI platform like this, then guess what will happen to the revenue? When you have 10 options for it, 10 platforms, they can originate loans at low cost, what will happen? Well, the revenue from fees will get lower because they compete. Based on what? Based on their models? If they are about the same, what will they do? They have to reduce their prices, right? And if they reduce their prices, also the revenue will likely to get lower. Now, an advantage for this company is that they are at the beginning. And you see here this huge total addressable market where they can increase a lot. So you have to see, to balance and assess the future outlook of this company, how much money they can make and grow, and also look at the competition. And if you are not afraid of the competition, you think that their platform is much better based on your own analysis, then Upstart is well positioned to grow more in the future. From this level, you can have more than double. So that's it for this video, and if you have other questions, please let me know in the comments.